Welcome to Rebank, your front row seat to the future of finance. Tanner Taddeo, welcome to Rebank.
Will, thanks for having me. Excited to be here.
Very excited about this conversation. So I'd love for you to introduce yourself. You guys are building a stablecoin payments business, and you have an incredible background too. So please capture that as well. But tell us who you are and what you're working on.
At StableC, we're ultimately a on-chain payments and treasury tooling company built for B2B use cases. So we help companies with merchant payouts, with treasury movements around the world, accessing different types of on-chain capital markets products like tokenized money market funds, tokenized T-bills and gold, etc. We've been at it for about a year now, seeing pretty good traction out there in the market. And it's just a really exciting time to be in the stablecoin space, because not only are fintechs the first adopters of stablecoin for cross-border money movement, but also we're starting to see uptick in the real economy, or the traditional economy, from like brick and mortar businesses and Fortune 500s that are starting to get into the mix. So adoption is definitely here. I think the next 3, 4, 5 years in this space, there's going to be a lot of value to be accrued.
How would you synthesize like the immediate use cases or focuses of your work at StableC now?
Yeah, there's two ways to think about it. There's like a macro vision, and then there's just the pragmatic, practical day in, day out operations. Like day in, day out, what we do is we help companies in the traditional economy, and by traditional economy, I mean like steel manufacturers, coffee bean import exporters, seafood import exporters, etc. When they need to pay vendors, or let's say that they have operations in like Brazil or Colombia, they will need to move a treasury movement, i.e. call it like $5 million capital injection to their Colombian entity. We help those companies move that capital into these economies around the world. So the two primary use cases that we see are treasury movements, and then merchant or vendor supplier payments. And what we offer is the lowest FX rates out there in the market, as well as same day settlement time into about 40 currencies around the world, all focused on the global south. So the work to be done for our customers is to get money into these countries to either pay a vendor or to top up their local bank account as cheaply and as quickly as possible. So that's the kind of pragmatic day-to-day on what we do. How that translates into like a wider vision, and tying it back to the benefit for the global south, is ultimately whether you're a merchant or a vendor in these different countries, typically you get paid net 15, net 30, and it takes, there's going to be some basis points that are taken off the top of that transaction. There's definitely, from the sender, you're going to be paid $50, $75, $100 a wire. And then it's going to take anywhere between 5, 10, 15 days to settle, depending on what currency it's going into. And so if you think about it from a business perspective in a different country in like the global south, if you have to wait an additional 10 days to get paid, a lot of those businesses have operational constraints from a capitalization perspective, right? And so sometimes you need to take out working capital loans to cover your costs for 10 days as you wait for payments to come in. And a lot of the real businesses, they run at 8% margin, 10% margin, 15% margin, and the seasons of import exporting, it's cyclical in nature, right? So some of these businesses, if they're waiting on a capital injection from an invoice to get paid, they might need to float themselves. And if you float yourself with a working capital loan, you'll get high interest rates in some of these countries. And so to the extent that you can settle same day and lower the cost of that cross-border transaction, the macroeconomic effect from that is that businesses no longer need to essentially get same-day loans or like working capital loans to cover operational expenses, which means that they have more capital in the bank to capitalize their business, do payroll on time, et cetera, et cetera. And you can see this like knock-on effect that if you can touch a lion's share of SMBs in emerging economies that have the ability to have this capital come in and settle quickly, you can reduce their dependence on like same-day loans or higher interest rate loans. And what that does ultimately is it means that these businesses have more capital in the bank to utilize for innovation, for payroll, for whatever their expenses may be. And theoretically, that should have a knock-on effect on global economic GDP, right? And so that's ultimately what we're doing step by step. It's a You have to squint to see that philosophically. But we deeply believe that at Stable C. And then, we think that starting from first principles, just helping businesses move money cross-border more efficiently will have those tangible effects that you'll see in the next 5, 10, 15 years to come.
Yeah. Yeah. So the majority of your clients, the sending businesses, are US based, or which countries are they in?
Yeah, today mostly US based. Yeah, they're pretty much all US based. We get a fair amount of demand from companies in across Latin America, across Africa, some in Europe, but mostly Africa, LATAM, and a little bit of the Middle East. Um, but from a regulatory perspective and a licensing perspective, it's much easier for us to onboard US based customers. So our primary flows are US outbound.
Okay, makes sense. So I thought maybe we could zoom out a little bit, talk high level around the kind of stablecoin payments opportunity right now. I think it's kind of easy to hear instant, basically free payments in terms of what's possible on stablecoin rails, and assume that that's just a better solution 100% of the time than TradFi payments. But I think one, it's not that simple, and two, there are a number of reasons why it's difficult to displace incumbent offerings in FS in general. And then maybe we can dive into some of the more recent news items. There's been some interesting stuff happening in terms of consolidation in the payment space with especially large incumbents making moves. So I'd love your views on those. So maybe to start at that highest level, I mean, like, how do you think about the stablecoin payments landscape, stablecoin payments opportunity?
Yeah, I mean, I think there's the cross-border payment space is roughly, depending on what consulting report that you read, it's roughly around 195 trillion. So that is the market that is set to be disrupted by stablecoins. But I also think that like there needs to be a dose of pragmatism in the space as well, where in the G7 or the G20 economies, stablecoin has a use case there, definitely, but those use cases are more of like stablecoin becomes or it serves as like a gateway to digital assets. So if you want to use stablecoin to swap into, tokenized money market funds, tokenized gold, tokenized bonds, and or use some of the data on chain to use that as collateral to unlock secured or unsecured private capital loans on chain, there's like that is what is starting to take off in the G7, G20 countries. Because ultimately the correspondent banking system works really well across the G20. And a lot of the banks participate in the SWIFT network. And as a result, like honestly, payments cross-border work pretty well. I could be wrong on this, but I'm not sure you're going to see a strong uptick in, US dollar to pound sterling trade being facilitated by a stablecoin because there's a ton of liquidity in the fiat markets and those rails work pretty well today. That said, where I think like the biggest opportunity in the stablecoin space today is definitely into like emerging markets is where stablecoins are having their kind of renaissance moment. But also for small businesses or mid-market businesses in the United States that typically don't have the privilege with working with some of the larger banks out there. Like if you're in the Fortune 500 and you have the privilege of working with a JP Morgan or a Goldman Sachs or a Citibank, great. Those guys have the best merchant banking experiences you could possibly imagine, right? From a foreign exchange perspective, forward swaps, derivatives, etc., access to capital markets. Like those companies are absolutely amazing at what they do, but to be served by them, you need to reach a certain status in your company, right? And so there's a ton of small business, there's a ton of mid-market companies out here in the United States that bank with a regional bank or maybe a local state bank or a credit union. And those banks typically don't have access to the best financial services that you could otherwise get. And some of the products that you're seeing be developed in the Web3 economy, you can take those financial services and distribute them out to businesses that are underserved by the major financial institutions today. And that is where you're, let's say that you're a seafood import exporter and you make 50 million in revenue a year, and you bank at like a local or state bank. You're probably leaning on some provider for your cross-border payments. They're probably charging you 100 basis points, 200 basis points for that trade, plus like $100 wire. And you have no visibility on when it lands. There's like this entire kind of opaqueness in that land. Mm. And so you can bring stablecoin through the Web3 economy and distribute that into the SMB and mid-market space. And that has a lot of utility for the companies in the United States as well. just to summarize that point, it's like stablecoins are really having their moment in emerging markets. For some of the larger companies in the US, you can use stablecoin to access different digital assets on chain. But the real value prop for like US based companies is to access better financial services than they get through their banking partners today.
Okay, got it. So if you use the example of that seafood importer exporter with 50 million in annual revenue, they are not sending wires or international payments via their bank. They're using a third party PSP or potentially multiple payments platforms.
Yeah, it depends ultimately. Like, is the non-political answer to that question is it depends. I mean, sometimes if if the business has complex operations, they probably use different payment processors for that for cross-border payments. And if they have a simple flow, like they just need to top up their Mexican peso account or pay one or two suppliers in Mexico, they'll typically do a wire. But that wire again is costly, takes a long time. They have no visibility on when it lands. So it just depends on the sophistication and or the complexity of the business's cross-border money movement. If you're moving into multiple markets, you definitely probably have one or two, possibly three different payment processors under the hood, all with different rates, all with different spreads, all with different like origination or like different FX sources. And so there's no real consistency in that pricing there. And again, you don't really know when the funds land. You just hit submit and they'll let you know when it lands in a few days.
And then in terms of the emerging market payments, I guess in a sense, at least in terms of what you guys are doing, it's like starting from dollars, US senders for the most part, and ultimately delivering local currency fiat into bank accounts in local countries. Most simplistically, I guess what you're doing is stablecoin sandwich. At some point fiat is converted into USD stablecoins in the US. There's a kind of cross-border leg which probably happens in stablecoins, and then there's like a conversion and off ramp in local currency in the receiving country. Is that the flow broadly?
Yeah, that's correct. Yeah, that's the flow.
And then how much work is there on I guess at your level in terms of connecting into various like local country banks and kind of plugging into the plumbing for local currency fiat payments?
Yeah, I mean that's a lot of the work that we do today, right? Is managing the orchestration and the navigation of on-chain wallets, and then subsequently you need to source traditional FX rates and then marry that with a digital asset spread, and then subsequently different providers will have different spreads and different sources of FX. So managing that orchestration and that data connectivity on-chain, and then making sure that you're running, of course, all the compliance checks on the wallets and the downstream bank accounts and the funding and the sending accounts, etc., is stuff that we do today. But yes, the lion's share on the back end is on integrations into partners that can A, receive a stablecoin, B, do the FX, and C, do the last mile payout. But the value prop that we have and that we portray out to the market is we are really the application layer for stablecoins. So we don't want to be in the infrastructure game. Ultimately, we build user experiences at the application layer such that like a CFO of a seafood import export company can open an account at StableC, log in, it looks like a traditional banking account, and you can just use stablecoin rails to send money anywhere around the world, right? Like I don't think, even if you take a proxy today of just a traditional business that uses a payment processor, unless you're a really sophisticated business, you don't really care if it's ACH, same day ACH, RTP, Fed now. And you're just like, I need to do one task, and that is to pay a supplier, and I want to do that at lowest cost and subsequently fastest settlement time possible. I don't care what the technology is, so long as it works. And right now, there's a lot of hype in the stablecoin space because everyone wants to talk about stablecoins and like talk about all of the technology that underpins it, which is great for this particular community of builders to be able to source ideas. But ultimately, there's a bit of an echo chamber going on there. And if you want to translate that to the traditional economy, you're not going to go out and sell a bunch of APIs to like a mid-market business in Kansas. Like ultimately what they're trying to do is they're running a business. They're trying to send money as fast and as quickly as possible. And they don't really care if it's, what is under the hood, so long as it works, it's compliant and it's trustworthy. And so I personally hope that like in 5 years, stablecoin will just kind of be ubiquitous, and no one really talks about it because it is just the rail of the future. Just like today, you don't really, if you go to a trade association, you're not really hearing those nuanced conversations around like ACH, same day ACH, etc. You're just like, hey, I use this payment processor and it works pretty good. And
Yeah.
that's ultimately when you'll see mass adoption, I think, of stablecoin in the space.
Yeah. Yeah. How much of a driver for these businesses who are actually making decisions around payments is the instant settlement? I mean, I get the sort of like transparency, visibility piece. Maybe that's part of it. But from an instant settlement standpoint, I mean, I guess theoretically they have like payment terms that they need to meet. So technically speaking, they're able to kind of hold on to their money for a couple extra days if it gets delivered instantly at settlement. Is that the value prop? There's like a couple extra days of management of their money and I guess potentially yield.
Yeah, yeah, exactly. That value prop, there's two things. If you're like institutional trading, which is where a lot of the stablecoin activity still today exists, right? So you see these big TPV numbers, all the things. It's typically being used by like institutional traders to get into and out of like currency positions, because they're trading a whole bunch of complex financial products. So that's where like the lion's share of the volume historically has been, still is today, but you're seeing more and more start to creep into the payment space. The instant settlement time is of significant value for companies that are doing treasury movements because you can intuit your way into it, right? Like if you are a large company and you're moving $10 million into South Africa or to Brazil, if it takes you if you're moving $10 million and it takes you 2 days, 3 days, 4 days, 5 days, that's 5 days of opportunity cost that capital could be put to work elsewhere, right? It could be in an interest, like a yield bearing interest account, it could be in a savings account, it could be getting put to work from an operational perspective. And so you lose out on the opportunity cost for large ticket transactions because it's just stuck in the correspondent banking ether. And so if you think about the capital efficiency gains that are lost because of time delays, it takes a massive hit on the world's GDP and world's overarching efficiency. And so that's why instant settlement is of incredible value for treasury movements, right? If you think about merchant payments, yes, on the merchant side that's receiving the payment, of course they want instant payments. On the sender, you don't really care because you're like, if you're sending money, you're kind of like, well, net 30, I need to get money in and then I can send money out. And so from the sender's side, it's about cost. From the receiver's side, it's about settlement time. And so stablecoin does have the promise. We still need to get there as an industry on cost because it's not that cheap today in comparison to the traditional rails. It is faster, that's for sure. So we still have a ways to go, but that's the value prop for like big corporations, senders, and receivers ultimately.
Yeah. Yeah. All right. So last kind of in the weeds technical question here. How would you map the economics of a traditional kind of cross-border fiat payment in maybe one of these corridors that you're talking about against the stablecoin solution? So there's the on-ramping component. If you're using the stablecoin model, maybe the equivalent would be like a correspondent banking if it's a regional bank or a community bank on the origination country side. Then there's the actual like Swift or stablecoin cross-border leg, and then there's the ultimate FX and local country payout side. Like how do those economics map, and like where are the, I guess, large cost savings and potentially opportunities for further enhancement over time?
Yeah, I mean, the cost savings on the sender and receiver side essentially are just in the sum total of the transaction value, right? So today, if you're sending, 100,000 into X country around the world, you might be paying 100 basis points or 200 basis points on top of an FX spread that's baked into the cost of traditional FX, right? And then plus on top of that, you'll get like $100 wire fee or something like that. So the overall cost savings are material, but the unit economics in the space today, I mean, what you're seeing, especially in the wave of a lot of M&A activity recently, is as most things in history do, they repeat themselves. And I think that you're starting to see a lot of this M&A and consolidation as a way to rebundle kind of on-chain financial services. So right now people are selling a bunch of piecemeal products, which is fine. But if you want to get the cost down, you essentially bundle that with other financial services and you use like a balance sheet of a bigger company to subsidize some of the costs today. And so I think over time you'll see like FX rates go to what, I mean, like the FX rates that you can get wholesale via JP Morgan, Citi, or Goldman today the stablecoin space is going to have to get there, full stop. If not, folks won't just implicitly move traffic because it's still going to be more expensive on the stablecoin side of the space. Second to that is that as you see a lot of this M&A activity happen, I think the costs in on-ramping, the cost in on-chain movement with like gas fees, the cost associated with the FX, and the cost associated with the last mile payout or the distribution of the fiat in country X. I think you're going to start to see a lot of those costs get bundled into other, like a wider package, which means that cost will go down. And my read of the tea leaves, which I am by no means clairvoyant, but if you just draw a through line to past fintech trends, is you probably see a rebundling of stablecoin cross-border payments into wider platforms, and then the price should theoretically come down there. What that means for unit economics in the space, I think, is still a little to be determined. I mean, our mental model, which could prove to be right, could prove to be wrong, is that if you take the same unit economics, the same model of making money in Web 2 for cross-border payments, which is like transaction fee, basis point fee, and then payout fee, if you take that same model and you apply it to Web 3, it's probably not going to work, because the whole promise of Web3 is that you can lower the cost of cross-border payments. So if you take the same economic model that you have in Web2 and you apply it to Web3, then why are we doing the technological paradigm shift anyway? It's supposed to be disruptive to a business model. And so right now, I just don't know how sustainable those business models are. And I think you'll see the unit economics change as M&A activity happens and as people find new ways to accrue value in the Web3 economy.
Very interesting. Very interesting. So, I mean, maybe that's the perfect transition point into general conversation around some of the recent M&A activity we've seen, and I'd be very interested to get your perspective as an insider here operating in this space. Just off the top of my head, Mastercard at least reported to be acquiring Zero Hash. There are, I think, multiple reports of like very late stage discussions between Coinbase and BVNK around an acquisition. Beam, right? Another stablecoin payments company was acquired recently, and then Rail, formerly Layer 2 Financial, who we had on the podcast a while back. So I'd love to hear like what you divine in terms of observing some of these tie-ups. I mean, you potentially referenced some of it around rebundling, but more specifically, like what forms do you see some of these deals pointing toward?
I mean, high level, it's good for the industry, right? It breeds an air of legitimacy into the space. It also institutionalizes a lot of the technology and a lot of the funds flows into the mainstream economy, which is, I think, good for the space. And overarchingly, I think it ratchets up pressure on the startups to continue to outmaneuver some of the titans of industry. It also puts pressure on the banks to figure out how they can guard against deposit flight, right? Because if some of these companies that are doing the acquisitions, if you start wiring US dollar out of a bank account into a stablecoin wallet, you're ultimately taking depository market share away from the banks, which is their bread and butter. So I think that level of competition and that level of legitimacy is overarchingly good for consumers and businesses, because if you have healthy markets, you should have competition in the space, and competition theoretically should breed better financial services, better cost structures for consumers and merchants. I'm happy to see some of the acquisition in the space. I think it's good for the overarching industry.
Yeah. When you were at Plaid, it was in a corp dev role or more on the like business or product side?
Yeah, go to market strategic partnerships. Yeah.
I see. I mean, look, maybe if you can pick one of those deals that we just ran through. Love any maybe more specific thoughts you have.
Yeah, I mean, I think just broadly speaking in the industry, I mean, there's a few things, right? Like generally speaking, M&A activity happens where you're either buying new markets, you're buying revenue, or you're buying new technology. And if you buy new technology, it's for distribution. If you buy revenue, it's to buy revenue. And then if it's to enter new markets, it's to enter new markets and distribute your existing technologies through someone's or some company's clientele or client base. And I think regardless of the, each one of these companies, whether it be MasterCard or Coinbase or Ripple, they all have their core competencies. And when you look at the deals, the question in the back of your mind is like, what is the strategic advantage? Is it for distribution? Is it for revenue? Is it for technology that you can take in and then distribute through your install base of customers? And I think that, like, going back to what I was mentioning earlier, like a lot of these titans of industry, especially in the crypto space, they have big balance sheets, they have large customer bases, and they have a core competency of a piece of technology that has gotten them to where they are today. And now they're looking to essentially acquire different technology, revenue, or markets around the world. And my just general, with no data to back this up, just rather looking at like the historical rose line of trends, my assumption would be to rebundle like Web3 financial services and stitch together kind of new holistic financial products that can compete with some of the large banks out there. And so that would be my general take on the industry and like some of the M&A that you're seeing.
Yeah. Yeah. You at the beginning, you talked about your kind of like long-term philosophical motivation here, which makes a lot of sense. I wonder if just from like a sort of distribution strategy standpoint, do you see more of an opportunity to specifically like is it about currency coverage? Is it about moving to be able to onboard originating senders of payments in other countries as well? Is it about building a multi-product offering that goes beyond just payments? Or is it about, I don't know, building some sort of like best in class, almost like payments endpoint, which you can then embed across a broad range of maybe partner platform and kind of, B2B2C type distributors? What do you see as the biggest opportunity for a business like Stable C at this stage?
Yeah, I mean, principally, we look at two things for our North Star. We look at, for us, it's like the application layer, right? So if you think about how cryptographic technology going to go mainstream, ultimately you need distribution of that technology. So you've got all these like tokenized products that are going on chain, whether it be private credit, whether it be money market, whether it be tokenized gold, whether it be Bitcoin. And what are the distribution points of those things today? Well, today you've got like Kraken and Coinbase and like all these consumer facing exchanges that those cryptographic tokens are getting distributed via. Right. And you've seen just businesses blossom off the back of that, right? Go public, all the things. And so and that's just in the consumer space. Now, if you think about the business side of the equation, you've got, okay, cross-border payments is having its kind of renaissance moment with stablecoin. You've got a lot of the asset managers that are tokenizing their capital markets products and putting them on chain. You've got some of the larger lenders in the industry in the US tokenizing their lines of credit and putting them on chain. And so all of this work is being done. Now the question is, where are you going to distribute that via? And for us, there's a ton of great companies that are building at the infrastructure level. Our thesis is to build up the application layer. And as a result of that, like it needs to be as simple and as clean and as intuitive as like, taking design principles from Apple, where you open up a StableC account, you log in, it looks like a bank, you don't need to question it, you don't need to understand Web3, it just works. And if you can design that experience and take some of the great work that is happening in the Web3 infrastructure space and tether that to a good application layer, then you're going to see, I think, that distribution start to open up in the B2B space. The proxy to that is like, what Coinbase and Kraken and OKX and some of these like crypto and like Bitso and Yellowcard, like what they have done, they have cracked the consumer distribution wide open, right? They've got these great experiences that you download on your phone, and you can put money in from a debit card bank account, and then you can buy all of this crypto. It's amazing, sleek experiences, and they've won a lot of market share because they have distribution. And so what we don't see is in the B2B space, there's not that many companies that are focused on building great application layer experiences for like SMBs or mid-market companies. And so if you build, the thesis being, if you build that and you can distribute efficiently the good products that are on Web3, then you own the distribution channel there. And so that's how you'll start to see more adoption of the traditional industry coming on chain. So that's our primary North Star, is to build great user experiences. And then from there, you should be able to tuck into that product and own different parts of the stack, whether it be payments, capital markets, lending, etc. But you should be able to tie in Web3 APIs infrastructure that makes cross-border payments seamless, that makes swapping into a tokenized money market fund seamless, that makes using your trading data, piping it to a smart contract. Smart contract unlocks a line of credit that allows you to capitalize your business. Should happen all within, an hour. And so if we get to that world in the next 3, 5, 7 years, then I think you're going to see a lot of like efficiency gains and productivity gains of businesses around the world.
Yeah, that's a compelling vision. That's a compelling vision. How did your time at Square Block inform your work, I guess, as a builder now? I think you're in a product role at Block,
Yeah,
right?
that's right. Product and product partnerships. It was really good. It was a really special group of people that we got to work with. There was like a moonshot, like a little moonshot factory inside a Block, and TBD just had some of the best best and brightest engineering, go to market, business, product, compliance, legal. It was just a really special team there. And so, those conversations, I personally was a novice and with regards to Web3. I've spent the vast majority of my time in Web2 payments and Web2 financial services around the world. So being around those folks really elevated my own understanding of the space. And, a lot of the stuff that we were looking at there was how do you build decentralized payment protocols? So if you're a liquidity provider, how could you connect to a liquidity seeker? And do that programmatically with like verifiable credentials and decentralized identities, tokens, etc. And it was a really great collegial atmosphere. And so, one of the things that we saw there was that, and the original thesis of StableC was ultimately that like moving larger tickets in stablecoin was tough because of the lack of liquidity around the world. And if you're doing small ticket transactions, it's fine. You can plug into n number of exchanges, API, send stablecoins, convert, no problem. If you're trying to move like $10 million, like it becomes non-programmable. You get an OTC experience, you have to call somebody, do manual reconciliation, i.e. you take the trade data, you put it in Excel, you send it to your accounting team. So what we saw just in virtue of building in that space and working with the ecosystem was that the space works really well for retail payments. It doesn't work that well for B2B payments. And so that was the original thesis of like, how do you solve that depth of liquidity? And ultimately what we discovered through StableC was like, yes, liquidity is still a challenge out there, but more so it's accessing Web3 infrastructure, which sounds trivial, but it's a non-trivial amount of work to go out and build, great user experiences to get folks into the economy.
Yeah. How do you think about the decentralization first point of view at Block versus the effectively almost Web 2 style application layer built on top of, highly performant infrastructure? But it sounds like without any of the sort of like philosophical baggage of traditional, crypto decentralization kind of maxi viewpoint. How do you think about those two things?
Yeah, I mean, I think if we were living in a world without regulations, then decentralized technologies would be incredible. And there are still pockets where decentralization makes a lot of sense, but it's, there's different types of software you can build. And when you build in a regulated space, like financial technology or healthcare technology, like the rules of the road are like you have to abide with financial, like the regulations, right? And then there are certain compliance protocols that you also need. And so to decentralize, like to truly live in a decentralized world, I think one can get there intellectually and one can get there technologically. So it's not a technical challenge and it's not an intellectual leap to understand a decentralized world and how it could work or should work. But ultimately, when you go out of like the Platonic theory of form into the real world, you do have these constraints, and those constraints are, you do need to upload different documents for compliance purposes, right? KYB, OFAC screening, sanction screening, CTF screenings, etc. And then ultimately, liability needs to be held by somebody, especially if you're participating in, economies that are rule-based economies. Someone needs to have liability if something goes wrong. In a decentralized world, like liability kind of goes out the window. And ultimately, decentralized compliance relies on trust. And trust is baked into our contracts in the Western world, right? Trust is like not a given, it's kind of a legal right. And you embed that into contracts with limitations of liabilities and liability caps and what happens if X, Y, and Z goes wrong. And then subsequently, from a regulatory perspective, you have auditors from all 50 states and or the federal government that if you are letting companies into your services and they are sending you money and you're moving that money around the world, you need to comply and document and own, certain compliance requirements such that if you do get an audit, you have the ability to showcase exactly, how you ran your checks and or did you file suspicious activity reports and all these things. And so when you take the like pragmatic and tactical approach of operating a payments business, you can't circumvent rules and regulations. You need to be able to comply with like state regulators or federal regulators, and then also you need to be able to comply with the regulations that are ever changing in different countries around the world. And so with that, it's still very much a centralized payments experience, and it's a centralized technology because you need these little nodes that hold on to liability that if something goes wrong, you can go to this person, ask, or like this company and ask for the underlying kind of compliance programs, transaction monitoring reports, etc. And I just don't know. I mean, maybe I'm not a maxi quite yet, but intellectually, I think it's a beautiful concept. Practically, I think it's quite difficult to implement in a highly, highly regulated space.
Makes sense. Tanner, listen, really appreciate the time. This has been a fascinating conversation.
Absolutely. Well, I appreciate the time, and yeah, I hope to run it back sometime soon.
Absolutely. I'm very excited about what you guys are building. Look forward to staying close throughout your journey. Tanner Taddeo, thank you very much for joining us today.